Hello everyone, and welcome to Trading the Eurex Gateway to European Fixed Income Markets. We have some exciting products to look at today, but before we get into that, I need to tell you that the intent of this presentation is for educational and informational purposes only. I also want to let you know that there is risk associated with trading any markets, and futures and options are no different. Also, I'm not affiliated with nor sponsored by or connected in any way with Eurex and Advantage Futures. They're not endorsing anything I'm going to share with you today. These are ideas that I hope you find helpful. They've helped me, and I'd like to share those ideas with you. To give you an idea of my background, I come from the floor point of view, so it kind of colors how I look at the market. What I do is I primarily trade. I have a chance to trade markets around the globe. I've also been involved with testifying as an expert witness in federal court, got a couple patents on securitizing products, and a third one on the way, hopefully. I've had the opportunity through a word-of-mouth network, which truly amazes me, to work with traders from over 36 different exchanges, 450 institutions, and 35 countries. So that's a little bit about my background, where I come from, looking at these markets. And I have been looking at markets that trade on the Eurex platform since this exchange started. And it's been amazing, the changes that we've seen. Let's just start right here. Actually, I like this chart, because Eurex is the home of the Euro yield curve. It offers futures that represent over 83% of all the major debt issued in the EU. That is a big deal. And there is no other place that you and I can find that type of product coverage. You know, when we think about interest rates, what does it represent? You know, one, it represents the cost of money. So that's what we see when we look at these individual interest rate products, the cost of money in these countries. It represents the economic health, or the perception of that health in these different countries. It's a measure of risk, right? So when we look at the 10-year yields, and that's the primary benchmark that the market uses, although for the euro, as you can see here for Germany, we got the Bund, bubble, and Schatz. They have the entire yield curve from short-term paper to long-term paper. In the other countries, we have 10-year products, except down with our friends in Italy, as you can see down here. We have long-term euro, we have mid-term and short-term products there as well. But in the and also in France, there's a mid-term product there too. But if we think about interest rates and what it does represent to us, you know, if you see these 10-year yields getting over 5%, it creates a lot of attention. Remember, just a few years ago, we went through that. And when it gets above 6%, people are saying, uh-oh, that country's in trouble. If it gets above 7%, then they're saying they have to be bailed out. They're going to have serious problems going in the future. So these are warning signs, is the way the market uses it. And we'll see money flowing into and away from these interest rate products. Now, in general, what we typically see is that when we see uncertainty in the marketplace, so when the stock markets are going down, if you and I looked at the Euro Stoxx 50 and it was going down, or the Stock Europe 600 and they're going down, if they're going down, that means people are selling those products, and it also means that money, it's going someplace. And one of the places it can go is to the products that you and I are talking about today. It can go to the interest rate markets, because that's considered a safe haven for funds in general. So when we look at that kind of capital flow, it's a typical relationship that we look for in that marketplace. And what's interesting, as we're going to see, there's some very specific reasons why Eurex started trading these other products. You know, at first it was the Bund bubble shots, the Buxel Bund bubble shots right here. This was the product line. Well, it changed for some very good reasons, and we're going to talk about that. Also, interest rates reflect events that are going on. And this year, well, in 2017 in Europe, that will affect fixed income markets. We got April 23rd coming up for French elections, May 7th for the second level of the French elections, the final election process. And then in September 24th, we have German elections. All of those can create volatility and movement in and out of these products that we're going to be talking today. Now, what's interesting also is the government bond issuance. Now, the large issuance of Italian, and that's the Navy, the one over here, the French, which is red, and also the German, which is black, debt makes for a liquid and active futures markets, and they sure do. And you know, one of the ones too, this little guy right down, or not little, another major chunk of debt issuance is Spain. And if you take those four countries, you take Germany, France, Spain, and Italy in the Eurozone, that represents 77% of the GDP. So these are significant markets in their own region, as well as Europe in total. Now, when it comes to the Bund futures, that's what we're looking at. Look at volume and open interest. And I've been looking and trading this market since it moved, since it started trading, actually at that time with the DTB and later on Eurex. And what's fascinating is the amount of volume. I mean, look at the volume, these vertical bars, look at the volume, and then look at open interest. Now, from the exchange point of view, what they have done is they've created a market, a product that the market wants, because people wouldn't trade it if they didn't see value in that aspect as a product. It also says something about the confidence of people who trade this product, that they're willing not only to trade it, but also to hold positions, and that's what open interest represents. You know, that number comes from the positions that are held open overnight. So it says something about the confidence in Eurex and this product. Now, for you and me, those are important parameters. But what's also important to us is liquidity, the ability to get in and out of our trade, and this volume that we're seeing makes that happen, makes it possible so that you and I can trade these markets from a very comfortable position. Now, let's check out these spreads that you're looking at for these different countries compared to the Bund. And you know, multiple events since 2008 global financial crisis have demonstrated that the Bund could no longer serve as a reasonable proxy to hedge government debt exposure in certain EU nations. Specifically, and that's what we're seeing here, diverging yields from the Bund created the needs for products that could better reflect the debt management of the individual EU nations. So for example, in 2009, see that vertical bar on the left there? This guy right here? Well, in 2009, with Italy reaching more than 100 basis points of difference from the Germany's rates, Eurex introduced the FBTP. That's a symbol for the Italian 10-year futures contract to sharpen the ability of participants to hedge exposure in the riskier EU markets. Remember all the discussions we had about what was going on there? Well, basically Eurex recognized that. And the markets really accepted it and used that product. Now, years later, with the EU debt crisis driving French yields further from those of Germany's and a French election in 2012, here we go, that's that middle bar right there. Eurex introduced the FO, or the French 10-year futures contract. And then in late 2015, with Spain and Italy diverging from each other, well, Eurex introduced the F-bond, or the Bono, as it's oftentimes referred to as, well, the Spanish 10-year contract, futures contract. So each contract that we're talking about here has a deep and liquid marketplace, allowing market participants to trade and hedge exposure more precisely than we've had in the past. So that's kind of the evolution of the products that we're talking about. We see these yields, we see these changes, and as a trader, what that means for us, it means opportunity. It means that you and I have product choices. Not only can we fine-tune the exposure we have in different countries, but it's our ability to get in and out. And the more choices we have, well, from my point of view, the more opportunities we have. Now, let's talk about this. And we're really looking at this change between German and French futures and their differences. So if we drill down to the German-French yield relationship, which is what this is doing for us, where once the Bund market served as a proxy for that of the French debt, because they were basically walking hand in hand. But if you look at the Brexit, if you look at Trump's victory, combined with the emergence and strength of the populism, which is a big deal now in France, it has really created a shift in that relationship. The relatively safety of the German and French debt represented to a point of negative interest rates, and that's changed. So once highly correlated, yield showed that fear is spreading in France, and the yield differences are evidence of that. I mean, look at this line. This line represents that difference in yield. So if there wasn't much of a change, it would be going flat. And actually for us as a trader, there would be no advantage to try to spread these markets or try to take advantage of that type of movement. But look at what we've seen. And it's relatively recent. And you know something? Chances are that's going to continue. So the opportunities that we're looking at here, because that's the way I look at it, it's an opportunity to make a decision about how to take advantage of this new, relatively new change. And that chart demonstrates that. Now here again, with the French 10-year futures, the bonds, if you look at the growth there, look at that spurt that we've seen. I mean, it's been doing well, but if you look at 2016 going forward, I mean, holy Toledo, this thing is really taking off. And it's probably going to continue to grow, especially with the events that we see around Europe and globally. We have a lot of geopolitical events right now that can really shake the markets. And what's fascinating to me is that we are all connected. And I know you know that. We're all connected. So therefore, when we see something or feel something in some part of the world, well, we're going to see it reflected here in these markets that we're talking about as well, too. Now, if you look at the difference here, if you look at the fixed income futures, comparison of volume and open interest, now we're looking at the complex. And what do you see here? You see volume on a steady growth. And that's a sign of a healthy market, that the market is attracting institutional paper. And that's what you need to support the market. You wouldn't see this growth without institutional support. And for you and me, that's a filter that tells us that they feel this is a fair market. Now, open interest, look at how that's really taken off here. And really just the last few months, starting in September, October of last year. That also is a sign, I think, as a trader, that's healthy. It says, one, that people are holding on to positions. They're not immediately getting out. And they also feel comfortable. They feel safe doing that. Institutions as well as you and me, we're not going to hold something overnight if we have any concerns about that. So it's another reinforcement to me of the health and the comfort that you and I can have in trading on the Eurex exchange. So that increase in open interest says, again, something about the market's commitment to what's going on in that total yield curve for Europe. Also, when it comes to hedge ratios, the one German 10-year Bund future can be hedged by 1.2 French 10-year futures contracts. And this gives a ratio about 5 to 6. So when we're trading that position, so it gives you an idea of what to expect. This relationship is the most correlated and liquid of the intra-country spreads, as the Bunds once served as proxies for the French exposure until that recent French liquidity growth that you and I just looked at. Now here's the contract specs. I have to tell you, I like this slide in here because I wanted you to see how they compare. And you know what Eurex did, which I think is kind of clever. They didn't make it a challenge for you and me to trade this. I mean, they both have the same terms, basically. $100,000 face value, 1,000 euros per point. We got quarterly contracts. We got 0.01% of par. So in other words, that's the tick size, 0.01. And each one of those changes 10 euros for either one of these contracts that we're trading. So simple things to keep track of. And all these other characteristics remain the same, trading hours and so on. Now let's talk about what's happening with this upcoming French election, especially when we're talking about fixed income. Now, what we know is that we have these two phases. The one coming up on the April 23rd, we have basically, it seems, 4 candidates that have risen to the top, and 2 of them are for Europe, staying in the EU, and 2 of them are saying they're against staying in the EU. So obviously the outcome can have a tremendous impact on how France may move forward. So in times of doubt, in times of uncertainty, we typically see interest rate markets going up, and we see stock markets going down. So again, Stoxx Europe 600, we would expect that to go down. But when we think about the Bund, when we think about the French 10-year bond, we're looking for those to go up because that typically is where capital flows. And also the probability of one of these candidates getting more than 50%, then you wouldn't have a runoff election, is probably pretty low. When that happens, that would mean in May, when they do run 2 weeks later, when they do run the second with between the 2 highest vote getters, that's where we're probably really going to see volatility, because that's going to become reality, whoever wins. And you know what they say and what they can get done, as you and I know with politicians, there's a big difference there. But the fact is, we'll have a feeling about perception, and perception drives the market. And that's what a chart shows us. It shows us human behavior, how collectively people feel about something that's happening around the world. And you and I are looking at products that's an excellent barometer to that kind of behavior. And what do we have here? Speaking of behavior, is that we have a Japanese candle. And from my point of view, I think of this as a behavioral tool. And the reason I do is I break it down by market concept. And this is a technique that I saw in Japan back in the mid-'80s while teaching a course at Bank of America. And a part of the course was to make some trades, and these were yield curve traders. These are people, and I haven't seen some of these banks recently, because they were banks that were customers of Bank of America, all trading interest rates. And I'd be very surprised if they're not trading and looking at the markets that you and I are looking at today. Anyways, I saw a gentleman drawing these candles, and I asked Kuno-san, the fellow I was with, what are these? And he was kind enough to share that these are Japanese candle charts. And what went through my mind is what I want to share with you, and that is what we would see and feel on the floor of an exchange. And so what you look at is the behavior. And I think we can break down buying and selling behavioral characteristics in these candles. So what you see here is that if the closing price is above the opening price, I have this, we draw a box between the open and close. And many of you are familiar with these candle charts. I would also like you to put your ideas aside for a minute about candles, because we're going to look at them differently. And for those of you not familiar with candle charts, what I'm going to talk about is not the typical way to approach this technique. There's usually about 80 patterns we could go through, but I feel that the value is more in terms of what it shows us, and we can melt those 80 ideas down to about 8 concepts. All right, so the close is above the open. I think, as you can see here, that it represents buyers. That it's not just a body to a candle, but it represents buying pressure coming into the market. It's that competition between buyers that drive prices higher. In effect, when we have a market, you have an auction. And you're familiar with somebody looking at something and putting in bids to try to capture that thing. Well, the same thing happens in the futures market or in any market that's a two-sided market. So it means that we're seeing buyers competing against each other, driving prices higher. That's the way I look at it. And then just the opposite on the other side. When the opening price or the closing price in this case is below the opening price, we see that red body or sellers coming into the market. Now, the shadows, we see the high didn't match the body of the candle. I think that represents sellers at higher prices. And when the low doesn't match the body of the candle, I think that represents buyers coming into the market. Something to keep in mind. When this market traded at this high price, when it did, and it did sometime during its life, that green body would have extended all the way to the high. And at that price level, it got high enough to find sellers. And sellers competed and drove that price lower. And the result, we see their footprints. And their footprints happen to be the shadow. All right, so the size of the bodies tell us something about commitment. How much the buyers want this market. If it's bigger bodies, it implies enthusiastic response to the market. If it's a smaller body, it implies a loss of momentum. Shadows, the larger the shadow, the smaller the shadow, represents a degree of rejection of those price levels. Now let's take a look at the French government bond. And what I'm going to show you is a characteristic, a couple things actually, that you and I think, want to be aware of on a daily basis when we trade these markets, and also with some of the events coming up. And what we're looking at is a 15-minute candle chart. And what you can see, I have these different numbers up here, the number of ticks in the first 15 minutes. And the times that you're looking at down here at the bottom, for example, those are Chicago times. I live in Chicago area, and those are Chicago times. So 1 o'clock in the morning, Chicago time, this product opens up to trade. Like 8 o'clock in the morning in Europe. So as it begins to trade, one of the characteristics is that it has the tendency to set the tone oftentimes in that first 15 minutes. Now, the larger that first 15, here's what I mean by tone, I should tell you that too, that probably over 60% of the time, the high or the low for the trading session occurs in that first 15 minutes. So typically, when the first 15 minutes is finished, what we would be looking for if the market starts making new highs is that it doesn't trade below that low. And here it did, just by a couple prints. But typically we look forward to move away from it. Like here's the first 15 minutes, and we didn't trade back below that low. That kind of set the tone. So I think that's important for us. Now, the larger that the ticks are in that first 15 minutes, it also sets up the type of day we may be seeing. You know, when we get over like 37 ticks here for the OAT, if we get above that for the French bond, we have a tendency to have a large move that will contain most of the action that we see afterwards. And that's what happened here. We look at the 32 tick move here, and we can see the market really took off, also broke to the downside. And look at this one. As this market rallied up, We had 33 ticks here. Look at the market, how it rallied up, and then it did break. And we also see it coming back off here. Here we have 35 ticks that ended up being the high of the day. And this market now traded below that first 15 minutes midpoint, and we see the market breaking down again. And that leads us to another characteristic I want you to pay attention to, or something that I find helpful. When you're looking at a market that trades multiple time zones, there are some behavioral characteristics that you want to look for. And here's some ideas to think about. One, when is it volatile? When does it have a tendency to move? How far does it have a tendency to move? All right, so let's take a look at that, and let's break this down further, because I think there's some other times of day that you and I want to pay attention to, not just that opening 15 minutes. And here's some examples. If we look at right here, is this movement you're seeing right here is around 7:30 in the morning, between 7 o'clock and 7:30 in the morning in the United States. Our interest rate markets, our currency markets, gold markets, metals markets start to trade on the cash side. And so it can add an element of volatility to the market. So around that time, between 7 and 7:30, you want to pay attention to the setup that we're seeing there. Because oftentimes, you could put a high here, right here, for example, in the interest rate market opening in the United States, that was the high for the rest of that day. So you want to pay attention to the size of that move, and also how does it fit in? Does it give us that kind of reference? You know, the second time that you want to pay attention to is right here, right before or right around 8:30. At 8:30, our stock market opens. And there we can see another element of volatility brought into the market. And in fact, what you also look for is how does the market set itself up as we go in to this new time zone? Typically, we have a small range. We don't have huge volatility as that 7 o'clock period or the 8:30 period begins. So if you go back up here to the top, you know, we have a smaller range there, not a dramatic move. That's not unusual behavior for that market. If we take a look at what happened after the stock market opened, what we saw starting in interest rates in the United States continued to the downside when the stock market opened. And you know, right here, that French government bond, it's reflecting that behavior. And it may be giving us opportunities to take advantage of that. So we want to look at time. We want to look at when this market has a tendency to move. And we also want to look at behavior of the candle itself. For example, what you look at here, when you see that larger shadow on the highs, I call that a rejection pattern. It implies a market that was green during its life that got high enough to find sellers. And the next thing you want to look at is the next 2 to 5 periods, because if this is true, that sellers are present, this market should start moving lower. And if it's not moving lower, in 2 to 5 periods later, chances are it won't. So when does the market move is important to us as well too. Whatever technique you're using, that when does the market move after your signal is a crucial element that we both should be familiar with. The other thing we want to ask ourselves as we look at this chart is, when does it go sideways? When is it quiet? When is it noisy in a sense? When do we have volatility? When do we have a market that stops to take a breath? Every market has that rhythm. And a part for us, if we're going to look at the market intraday, not that we have to, we could trade a daily or a weekly chart as well, but we want to be aware of that behavior. It's an important reference for us. And that, you know, that's what we're seeing. We're seeing different phases in this market as it moves. You know, we go from imbalance to balance. to imbalance to balance. That's the reaction we were seeing there for that market. All right, now let's move on and let's take a look. And this again is the French bond, 36 ticks. That's really a large move. And look at that move. It really basically contained almost the entire day. And again, as we get into the US time zone, we're seeing some further market volatility. But that basically, this first 15 minutes remained dominant. Down here in the on this day is 25 ticks. That could easily trade to either side of that market, but it was the low. As we see the rest of the session, the market moved. And here, where we saw so much volatility in the US session, the movement here, it's about the same as what you see over here. So it basically, whatever was driving that market fundamentally, and that's what fundamentals do, they create perceptions of what the future may be, and we see the market absorbing that information. That's what we're looking at. And how did it put the brakes on? How did this market that was so volatile and directional put the brakes on? Well, look at those shadows at the highs. So it's telling us we're finding sellers at those levels, and we never came back to take them out. Even on the downside, look, we would say on the floor, we would say this market was very bouncy at these lower levels. And it means that there's orders coming in at these lower levels. The market sells off. Remember, that shadow on the bottom, that was red during its life. And what happened at that level? Well, we found some buyers. And we found them again, and we found them again, and we found every time this market went below 147 even, 1, 2, 3, 4, 5, 6 times that this market went below that level, boom, they came in and bought it. So it tells us something about market action. If I'm looking to sell that market that day, I got a lot for this market to overcome if I'm interested in being a seller. So that's a pretty strong reference for us, isn't it? And it's just by looking at some of these basic behaviors that we're talking about. This day, a 29 tick day, and again, this market maintained that movement until interest rates started opening in the States, and we saw it backing off a bit. Right here is the stock market opening in the States, and it backed off from there as well. All right, so let's take a look now at the Bund. And this is that, no, I'm sorry, this is still the French contract. And again, you see those behaviors, 67 ticks. Holy Toledo, that's huge. So what does that mean for you and me? It means, do you expect this market to trade much beyond the high or low of that first 15 minutes? And the answer is no. Chances are we're not going to see a strong directional move beyond this range. It doesn't mean there's not opportunity. You're seeing movement here. You're seeing opportunities for us to hopefully capture some of that movement. But it gives us an idea right out of the get-go of what we can expect to see unfolding. Here, we got 29 ticks, about half that size, less than half that size. Or we see a market that stayed directional. 16 ticks, that's a very small range, and it's easy for the market to trade lower, beyond that, and also to trade above it. So to see the market switch back and forth, if you and I had a 16 tick opening or even 11 tick opening, wouldn't be surprising. But if you and I see something large meaning greater than 60 ticks, or actually greater than 40, you really wouldn't expect that kind of volatility that day. So it gives us some clues to measure. Now, you and I could do that on Monday after the French election. We could see how is this market absorbing it, and a barometer that we may want to pay attention to is that first 15 minutes. Now, here is the Bund. And you're seeing smaller ranges for at least during the same period that I was looking at for the French, 19 ticks, 26 ticks. When you get above 30 or so in the Bund, that's really a larger move for that market out of the get-go. The characteristics, the same kind of things that we've been talking about. Those shadows, for example, are clues for us. And if you look at on this day, the 26 ticks, we basically stayed contained inside that range. We traded a little bit below it, buyers came right back in. And at the end of the day, as we went towards a close, as the US was finishing up, we see the market gave us that push to the upside. And look at these lows here. Here's that rejection pattern that you and I talked about. The market breaks lower, the red candles, boom, buyers come in below 162.90. Boom, buyers come in again below 162.90, and we get follow through. In the next 2 to 5 periods, is this market moving higher? Yes. The right kind of behavior that you and I would want to see. Just a couple more. Here's 35 ticks. And again, we didn't come back down to test that low. We stayed in the upper half. And actually, if you can move beyond that, like we're seeing here, then chances are we're going to continue. That would be typical behavior. But check this out. Well, 34 ticks, that's a pretty big one too, right? But look at when we went beyond that range. All right, now look above here at the behavior we're seeing. And what are you and I seeing above 162.90? Above 162.90, they're selling this market. They're not buying it up here. So the probability of a big move to the upside, it's rapidly decreasing. And again, when did this occur? It occurred, as we're finishing up the European session and pre-US interest rates and stock market behavior. So it's just fascinating. 24 ticks, and you can see how the market reacted to it. So my suggestion is that what you might want to do is take some time to get a feel for how these markets unfold. Our job as a trader is to look for those opportunities. And a part of looking for the opportunity is also determining our risk. If we don't know the risk for a trade that we're willing to take, we should never do the trade. Because will all of our trades make money? No. And they don't have to. The issue with good risk management, you and I could have a productive trading, identify productive trading opportunities over the long haul. And that's the key. So risk management is essential. And that's why you want to look at how did the market react to this? After that first 15 minutes and we start moving directionally, how far does that market move? Is there an opportunity that you and I could take advantage of? In this case, it moved a little bit more than 15 ticks. And if we know after the first 15 minutes that it moves at least 15 ticks, well, maybe you and I take some profit. So at 10 ticks or 11 ticks, we take half off. We move our stop up to where we got in, let's say right here, and we're stopped out on the second half of that position. If the market continued, hallelujah, and we may be able to take advantage of a further movement. Like you would here, the market did continue in that direction. So I think it's important that you and I take some time to look at the markets in terms of how they're unfolding and when we're seeing movement. Now, I wanted to show you one more thing. And that is, this is the spread between the French bond and the Bund. It's a 120-minute chart. It's a 15-period simple moving average. And again, with moving averages, like any other technical study, if you want to move this to the right, then you'd increase the number of periods. If I went to 20 periods, this would shift this over to here. If I went to 10 periods, it would move it to the left. It would make it more sensitive in terms of its movement with respect to the spread. And what you can see are a couple things. What fascinates me about this is that this spread rocks and rolls. It's got some volatility to it, which means opportunity for you and me. And what we have to look at is what tools do we use to capture some of that opportunity. And what you're looking at here on this moving average, when the market trends, and again, what you and I could do is we could say, what time of day is this occurring? When do we expect this kind of a movement in this spread so that you and I can take an advantage of it? Here, the market rallies up and then it breaks right back down to that spread. We could also put in objectives around a moving average. So for example, we could say that in this spread, what we're looking for is 10 ticks, or that 5 ticks above I will enter the trade, and 5 ticks below I would exit the trade of the moving average. Now we got to evaluate how much risk I'm going to take to do that. But if I was going to say 5 ticks, and I can get 10 ticks at minimum out of that trade, maybe I take 9 ticks, move my stop up to break even, and if this continues higher, hallelujah, and if it doesn't, that's fine too. We take a little profit, put that in our pocket, and now we break even on the second half of our trade. What you don't do is this. If I take a half of my position off, and let's say I get stopped out on the other half, and I do not get back in, because right here I should be getting back in. I don't say, oh, I should have kept my whole position on. That's in hindsight. When you and I establish a trading strategy, it's critical that we follow that strategy. And if we don't have the confidence and faith in the strategy, we should not be trading it. So when it comes to volatility, this spread, I think it's beautiful. And we have some events coming up that may add some additional volatility to this. So I wanted you to see that. Now, first, I want to thank you for sharing part of your day with me. And I hope that you gain some ideas and insights into these fabulous fixed income markets. And also, I want to point you towards, Eurex as a source of information. And the website, EurexChange.com. And you can get a hold of Matt. You don't have the ability to email that there, but you could give him a shout. Give him a call at 312-544-1086. I know he'd be happy to hear from you. He's there to help provide you with information so that you can make an informed decision when it comes to trading. And Advantage Futures, they have a whole source of information, a whole variety of sources of information. So please take advantage of that. Obviously you're a motivated person or you wouldn't be here today. You're willing to take some time, precious time, out of your life to investigate something maybe you're not looking at. And maybe you'll find some opportunities that'll be very rewarding, I hope they are, for you in the future. So I wish you the very best in your trading and much success in what you trade. Watch out for these interesting markets that we've been talking about, especially with the upcoming events that we have. And I do hope our paths cross again. I want to thank Eurex and Advantage Futures for making this possible. They allowed us the opportunity for you and I to explore these topics. So again, take care. I look forward to our paths crossing again.